So we are back with a very important topic to be covered in today's video. We have already covered the very important topic related to depreciation and the foreign exchange arithmetics. So if you have not covered those videos, kindly please do subscribe the channel right now and then find those videos over there. And further, if you want to prepare for the upcoming exam of JAIB, then there is a sure success waiting for you. Just need to follow the full course videos and the case study videos and the chapter wise previous questions, and that's it. Sufficient, more than sufficient. Just cover it, and that's it. So you can be following us the same thing you can be getting through the WhatsApp. You just need to WhatsApp us writing JAIB on this number, that is 83609 44207, and we'll be sharing each and every detail with you. Now, coming back to the topic of today video, it's related to the YTM, that is a yield to maturity. YTM is yield to maturity. So we'll be discussing each and everything related to it because the basics are very much required if you're preparing for the accounting and financial management for bankers. Because even if you're a non-commerce students, you need to understand the basics of it. Now, first of all, let's understand the basic related what is debt. Let's consider the case of a person A who has borrowed the amount from the bank XYZ, right? Now, in that scenario, person A is a debtor and person XYZ or the bank is a creditor here, right? And it's a sum of money which is actually due by one party to the another party. The person A is to pay back this amount to the XYZ. So the obligation is on person A so as to pay back this amount in time, right? So that is a case related to the debt. And when we talk about the companies, so I was talking about previously about the individual, but when we talk about the companies do take the debt in multiple forms, like XYZ companies there, right? So they can be taking a term loan from the from the bank, or a CC limit or overdraft from the bank, or it can be the case that they are having the trade creditors, that during the operations they basically took the debt from their vendors or raw material providers. And also it may be the case that they have issued the bonds and debentures. The bonds and debentures also acknowledge that they have taken the debt. So it may be the case that they have taken the debt through issuing the bonds or debentures. Now in this particular chapter we are going to talk about the bonds and debentures in detail, and also they can be generating the cash inflows by issuing the equity. Equity is totally different. That is actually not covered under the debt. That is totally different part. That is why I'm marking it with a red pen over here. That equity, when the company do issue the equity, people do invest and become the part owner of the company, and the company gets the money. But the equity money is not to be returned back. It will only be returned back if there will be surpluses and the company is liquidated, only in that scenario, otherwise not, right? But these all resources from where the money is taken, whether it's the case of the term loan or CC overdraft or the trade creditor or the bonds or debentures, these are to be returned back, these are to be paid back, right? Now, let's understand the terms which are associated with the bonds. Now, but before that, let's understand what are the bonds, right? So what are the bonds? So bond is an instrument. It's particularly a debt instrument. First of all, bonds or debentures. These are the debt instruments. Let's say guess company A is there and it issued the bonds, right? It issued the bonds, and here are the investors. Let's say I'm just naming them investors over here. So they invested the money into it. So bonds come with a particular maturity, right, in general, and also there is mentioned a coupon rate, that what interest will be paid to the investors. Like we do keep the deposits with the bank. The bank is having the obligations as to pay back the deposits to us when demanded or on maturity, right? Whatsoever the case is, and some interest is paid by the bank, right? So in that same scenario, the bonds are issued by the company which are acknowledging the debt, and the investors will be investing the money, the company will be getting the money, and in return the company is to pay a certain amount of interest. right? Certain amount of interest is being paid to the investors. And also on the maturity, the principal amount, that is a face value of the bond, is also paid back to the investors. So that's a nomenclature, the terms associated with it, we will be learning it all. So let's say case the bond is amounting rupees 1000 and 10% of the coupon rate and is issued for 5 years period. This is something mentioned like this, right? Now here rupees 1000 is indicating what? This is indicating the face value of the bond, or we also name it to be the par value of the bond. Face value, par value, one and same thing. This is the value which will be paid back to the investor at the maturity of the bond, right? The other one, it's related to the coupon rate. Now this is a fixed amount of percentage of face value which will be paid to the investor or the bondholder each and every year generally, right? That is a scenario. So the person A, or let's say person A is the investor, the person A will be getting the amount of rupees 100 each and every year for the next 5 years, right? Next 5 years. So 5 years is what? 5 years is the maturity of the bond. This is the maturity of the bond. Getting the point? So if I am to indicate the bond in the timeline, how I'll be indicating the bond on the timeline? Let's have a look at it. So let me just draw the timeline for you. And we are having the different years: 0, 1, 2, 3, 4, and 5. Right? So you just invested the money right here, right? And at the end of every year, you have to get coupon. Coupon is basically calculated on face value of the bond. So 10% is a coupon which is mentioned and it is calculated on face value, that is rupees 1000. So we'll be getting rupees 100 every year for the next 5 years. This is the return that we'll be getting. And also on the maturity of the bond, we'll be getting the face value of the bond, that is rupees 1000. So these are said to be the cash inflows for the bond, right? These are said to be the cash inflows for the bond. So face value is said to be the par value that is actually stated on the face of the bond, and it is actually representing the amount which is borrowed by the company, which will be paid back to the customer, right? And we also name that the amount which is paid back to the customer at the maturity of the bond, this is also said to be the redemption value. When the bond is redeemed, what amount will be paid? It is a redemption value of the bond, right? And rupees 100 being received, this is a coupon. This is a coupon being received. And rupees 1000 which was initially invested, this is basically showcased with a negative sign because it's a cash outflow. This is a face value or the par value, right? So that is the scenario. So you have understood the term related to what is face value, what is a coupon rate, and what is a maturity so far, right? And what is redemption value? The value which the bondholder will be getting at the maturity of the bond, it is said to be the redemption value. It is a redemption value. And what do you mean by market value? The market value. The bonds are also traded in the secondary market. Like XYZ company issued the bonds, right? And these person invested A, B, C, D, E. These persons invested in the bonds, right? And later on they want to purchase or sell the bonds in between the other customers. So when the primarily the bond will be sanctioned or bond will be issued by the company over there. That is actually the primary market. That is actually the primary market. And when they make sale purchase in between them, that is a secondary market. That is a secondary market, right? So depending upon the interest rate scenarios, the bond prices will go up and down. Depending upon the required rate of return, the bond value will go up and down. And let me tell you very interesting relationship between the bond value and the interest rates. So here I'm having the bond value and here I'm having the interest rates, right? So if the interest rates go higher, the bond value will lower. And if the interest rates go low, the bond value will go higher. So there is a inverse relationship between the bond value and the interest rates, right? So when the bonds are traded on the stock exchange, the market value of the bond is actually the price at which the bonds are bought and sold. And definitely the market rate, the market value can be different from that of the redemption value or from that of the other values. Is that clear? Is this particular point clear to you? Right. Now let's consider different types of bonds. Now I just told you a very generic thing that you will be getting a fixed bond. Now it may be the case that you're getting a fixed bond, then it's said to be the fixed rate bond. But it may be the case that you're getting a floating coupon rate. The particular coupon rate is not fixed. It's actually based upon some benchmark. Let's say SOFR, or it may be related to the LIBOR, London Interbank Offer Rate. So in that scenario, it is what? It is a floating rate notes over there. And also very important point, it's related to the zero coupon bond. In case of zero coupon bonds, there is intrinsic yield. There is intrinsic yield, right? Zero coupon bond, as the name suggests, that no regular interest or coupon will be paid. No regular interest or no coupon will be paid, right? So let's say case person A invested into the bonds, so no coupon will be given, right? And when the company will be issuing the bonds, let's say 1000 rupee bond will be issued. The par value is rupees 1000, but it will be issued at a discount. Let's say when the zero coupon bonds are issued, it is issued at a discount. Means the person A is not to pay rupees 1000 when he purchased the bond from the company. He just paid, let's say, rupees 950. He just paid rupees 950. Let's say it was having a maturity of 3 years, and at the end of 3 years, the person A will be getting the par value of rupees 1000. So this 50 rupees was the intrinsic yield earned by the bondholder, but no regular interest will be paid, right? So that's the case of the zero coupon bond. What type of yield there will be there? There will be the intrinsic yield. We name it to be the intrinsic yield. I'm just writing it over here. It's intrinsic yield, right? And what about the high yield bonds? High yield bonds are the junk bonds because those bonds are not secured at all. Generally, what happens whenever the company is to issue the bonds, the credit rating is to be done. And when the credit rating is not acceptable and still the company issues the bonds, it means the company is carrying a very high alert rate or very high risk rate. So when the risk is quite high, definitely the returns will be much higher because there is a simple concept that higher the risk means higher the returns, right? That's the scenario. Okay, so those are said to be the junk bonds. And then it's a case of the convertible bonds when the debt instruments can be converted into the equity instruments. That is said to be what? That is said to be convertible bonds. I told you that the bonds and debentures are the debt instruments and the company needs to pay back the amount. There is an obligation on the company. So as to pay back the amount back to the bondholders, right, on the maturity or on the redemption, right? But in case of convertible bonds, they comes basically with an option that the bonds can be getting converted into the equity, into the common stock, right? And it is beneficial for both for the company as well as for the bondholder. How come? Let's have a look at it. So let's take the scenario that company XYZ has issued the convertible bonds, right? And the bond was amounting rupees 1000. And the conversion ratio was previously given that for every bond, 5 equity shares you can be getting converted. Like for one bond, you'll be getting 5 equity shares, right? So the conversion ratio was given to be 5. Okay, that was the scenario. Now, on that particular day when the bonds were issued, the price of the share was rupees 30 only. The company share price was rupees 30 on the stock exchange. Okay. Now let's say guys, after 5 years, the person wanted to exercise the right, and at that particular point, the price of the share was rupees 300. After 5 years, the price of the share was 300 rupees now. Now for the bond holder, there will be benefit because instead of getting rupees 1000 back, instead of getting rupees 1000 back, the person will be getting rupees 1500 because one share is particularly pricing rupees 300 and the person will be getting 5 shares. So 5 into 300 means 1500. So the person will be benefited, and also the company is benefited. How come? Because otherwise the company was to repay the amount, but now the total amount is converted into the form of equity. The company is not to repay the amount, right? Because when the bonds are converted into equity, equity means that you are the part owner of the company and no amount will be paid to you, right? So that is beneficial for both, whether it's the bondholder or the company, right? After that, it's related to the inflation indexed bonds, the bonds where the principal amount and the interest payments are indexed to the inflation, that based upon the inflation, those are the inflation indexed bonds. And when there is backed security for the bond, that is said to be the asset backed bonds or asset backed securities. Then it is a case of the subordinated bonds. Now, subordinated bonds, otherwise the debt instruments are having a high priority. When the company is liquidated, the debts are paid at a higher priority. But when it's related to the subordinated bonds, they are having a lower priority for the payment if the company is liquidated. Then there are the perpetual bonds. Perpetual bonds are those bonds where is there no maturity, where there is no maturity, right? And these bonds are also said to be the console bonds. Direct questions can also be asked in this scenario, so kindly pay attention toward it, right? Bearer bonds are just like the bearer check. The person who is carrying the check or paper certificate is the owner of that particular bond, right? That's the scenario. But these bonds are very risky because if they are lost, the money is gone, right? So those are the bearer bonds. The last one, it's related to the government bonds. Government bonds, also said to be the treasury bond issued by the national government, and they can be no default, so they are carrying no default risk. After that, it's related to the valuation of the bonds, very much important. This is very much important so as to understand the fact that how the bonds are being valued. But before understanding this particular point, let's understand the case of the annuity. If I am not basically known with the concept of annuity, let's have a look at it. Let's say case there is a timeline. We're considering a timeline, and we're considering timeline for a bond 0, 1, 2, 3, and 4. We're considering a bond which is having the maturity of 4 years. Okay, so it's actually rupees 1000 bond with 10% of the coupon for 4 years of the maturity. As I told you, in general scenario, the person will be getting rupees 100 for each and every year. Rupees 100 at the end of every year, right? And you know, when you're getting a fixed amount at a regular interval, then it forms a annuity. When you're getting a fixed amount at a regular interval, it forms a annuity. So here, the interest payments or the coupon payments which I am receiving over here is forming what? It's forming a annuity. It's forming an annuity, right? It's forming a annuity. So it is very much easier for us so as to calculate the present value or the future value of the annuity. That is very much easier. And annuity is of two forms. One, it is a ordinary annuity, and the other one, it is a annuity due. So if you're getting a fixed amount in the beginning of the period, so if you're getting a fixed amount in the beginning of the period, this is the case of the annuity due. And if you get the fixed amount at the end of the period, then it is a case of the ordinary annuity, right? So that is the scenario, right? And for each annuity, there are two values we may be interested into: present value and future value. And also for the annuity due, the same scenario is there: present value as well as the future value. And in my many of the videos, I've told you the idea related to that. If you are known with one value, one formula, you can be learning all the four formulas, right? That will be covering in some other videos. But for now, the point was related that the coupon payment that we are receiving at a regular interval is forming an annuity. It's forming an annuity. And whenever there is nothing mentioned that you are getting it in the beginning of the period or in the end of the period, we consider it to be the case of the ordinary annuity. We consider the case it to be the ordinary annuity over there, right? That's the first scenario. So if we are to get the present value of the same, let's say case whatsoever the returns I'm getting over here, I want to get the present value of the same. I'll be reducing the value to the present. I'll be reducing the value to the present, at what value it is today. That what value it is today. So we are going to discount the future cash flows accordingly, right? And also you're getting the par value or face value at the end of the tenor, that is rupees 1000 I'll be getting at the end of the tenor. So I'm also to reduce this particular value. So if I discount all those values at the required rate of return or the market rate, then I'll be able to get the present value of the bond. That was the main funda. That was the main thing I wanted to do, right? So if the particular bond is 1000 10% and for the issued for 4 years long, and I am interested in calculating the present value of the bond, there are two ways. One, it is a lengthy way, and one, it is a easier way. Now we are short of time in the exam too, so we'll be going for the easier way only, right? So the formula is quite easy. I'm looking for the present value of the bond. All right, I'm looking for the present value of the bond. So we will be calculating the PVIF and PVIFA factors. Now these things are quite new to you. One, it is related to PVIF. The other one, it's related to PVIFA. PVIFA, right? So PVIF, that is a present value of interest factor, right? Present value interest factor. That is actually related to what? The formula of the discount rate. Discounting factor, the formula for the discounting factor. The discounting factor formula is 1 divided by 1 plus r raised to power n, and that is the formula. This is the formula for the PVIF. And in the same way you'll be calculating the PVIFA, just press the grand total button in the very end, right? Now just pick up this simple calculator along with it, because when I'll be solving, you need to solve along with it. Only then you'll be able to learn the things well, right? So as I told you, the particular interest component or the coupon component is forming what? It is forming an annuity, right? So for annuity, we'll be using the PVIFA. For annuity, we'll be using the PVIFA means for coupon, right? And for the face value, we will be using the PVIF factor. So face value, and in brackets, it's PVIF at what required rate of return? That is KD percentage, and N is the maturity. KD percentage is actually the required rate of return, which will be separately given to you in the question, right? So it is for the first factor plus the second factor would be related to the coupon value, and for coupon it is forming an annuity. So present value interest factor of annuity, PVIFA, for the required rate of return and n number of years. So this is a simple formula for calculating the present value of the bond. Now let's consider the fact that the required rate of return is given to be 12%. We're just considering, assuming it, right? It is given to be 12% over here. So how we'll be solving it now? So it is, the face value is rupees 1000. So 1000 over here, and PVIF, KD percentage means required rate of return, which is not 10%. That is a coupon rate. The required rate of return is 12%. N is the maturity, which is 4 years, plus coupon is 10% of 1000, that is 100. PVIFA as it is, because that's a nomenclature, we will be solving it, and 12% again and 4, that's it. Now we need to solve, right? So 1000. Now just remember this particular formula, 1 divided by 1 plus r. Now we have to put the values. R is 12%, so it is decimal form of 1.12. 1 plus 0.12, 1.12. N is 4. So we just need to solve this thing. So 1 divided by 1.12, and now press the equal to sign for 4 times number of n, right? 1, 2, 3, 4. So the PVIF value came out to be 0.6355. 0.6355, right? And I just did nothing. There is simply written 0.6355 on the calculator right now, right? And I'll be simply pressing this GT button. If you're able to locate the GT button over here, right, on this side, particular moving finger side. So I'll be just now pressing the GT button. So it comes out to be 3.03. So it multiplied by 3.037, and that is it. So multiplied by 100 plus 635.5, and the answer is 939.2. 939.2. Okay, so this is the present value of the bond. This is the present value of the bond. So I'll be repeating you again. So we were having the bond which was having the 4 years of the maturity, and we were to receive rupees 100 each and every year for the 4 years. At the end of the 4 years, I'll be receiving rupees 1000 also. Now, I was interested in calculating the face value of the bond in the present value of the bond. So I'll be discounting all the cash inflows. That is the first method. Or I can simply be locating this particular amount, that the interest amount or the coupon amount that I'm receiving every year is forming an annuity. So I'll be simply be using the annuity formula so as to solve this thing, right? So that is the particular PVIFA that is forming particularly PVIFA. The coupon part is forming the PVIFA, and the face value that we are receiving in the end is forming a PVIF value. So this is forming PVIF value, right? So this is how we just solve the thing. So we just wrote the present value is equal to face value. For face value, it is PVIF, and for the coupon, it is PVIFA. And then we just solved it, and that's it, right? And magically, or I can just telling you a fact that I was already knowing that the answer will be lesser than 1000. Answer will be lesser than 1000. How come? Let me just tell you the thing to you. So if the coupon rate is equal to the required rate of return, in that scenario, what happens? If the coupon rate is equal to the required rate of return, in that scenario, the present value is equal to the face value of the bond. Getting it? The present value is equal to the face value of the bond. And if the coupon rate is lesser than the required rate of return, that the market rate is higher than the coupon rate, then in that scenario, your present value will be lesser than that of the face value of the bond. And if the coupon rate is higher than that of the required rate of return, that will be implying that the present value will be greater than the face value of the bond. Now, the question we just covered is actually belonging to the second category over here. How come? The coupon rate is actually given to be 10%, required rate was 12%, and the present value we calculated was 939, and the face value is 1000. Getting it? So, in a way, I was already knowing that the answer will be lesser than 1000. Is that clear? Right? So this is how you can easily be solving the questions. Now just let's have a look at the questions over here. I already told you the things related to it. Now we'll be solving a question for the same. So a bond whose par value or the face value is given to be rupees 1000 bears a coupon rate of 12%, has a maturity over a period of 3 years, required rate of return is given to be 10%. What is the value of the bond? Now, simply saying, first thing that will be applying the logic. Now, the coupon rate is 12%. So, we simply know that the coupon rate is greater than the required rate of return. And when the coupon rate is greater than the required rate of return, what does it indicate? It indicates that the present value of the bond will be greater than the face value. Means the answer that we'll be getting in the end will be greater than rupees 1000. Right? That's the first case. Now let's solve the question. So let me just write the formula that the present value is equal to the, first of all, face value. And we know the face value is basically adjusted for PVIF, KD percentage, and N. And then it's the coupon that we need to calculate, and for coupon it's forming an annuity, so it's PVIFA, KD percentage, and N, right? That's the scenario. Now after that, we are getting the coupon on yearly basis. It may also be the case that you're getting the coupon on half yearly basis. I'll also be making you understand how to solve such questions. Now the face value is rupees 1000, so I'm just substituting the values. So PVIF, and the required rate of return is given to be 10%. So it is 10%, and the maturity of the bond is given to be 3 years. Coupon is calculated for the coupon rate. So 120. So 120 and PVIFA. Again, the KD percentage is 10%, N is equal to 3. That's it. Now I'll be solving the value for PVIF. Same way, we have to just use a discount factor formula, that is 1 divided by 1 plus R raised to power N. That will be 1 divided by R is 10%, so 1.1 divided by raised to power 3, right? That we need to solve. So 1 divided by 1.1 and raised to power 3. So pressing the equal to sign for 3 times. 1, 2, 3. So it is 0.751. So 1000 multiplied by 0.75131 plus, just simply pressing the GT button, 2.488 something, right? So multiplied by 120 plus 751.31, that is 1049. So the answer came out to be 1049.73. So that is answer. Is that clear? So this is how easily we can be solving the question like this. Seems to be difficult, but if you understand the concepts, it is very much easier to understand, right? So I already predicted that the answer will be greater than 1000, and we got the answer greater than 1000. So if you feel like that this video was helpful for you, kindly give this video a thumbs up, and don't forget to share this video. And if you are new to our channel, do subscribe to our channel and press the bell notification icon. So that will be all ready to this video. Thank you so much, and see you again in the next video tomorrow. Happy learning.